There's talk as well of how the premium between the price on COMEX and LBMA and the Shanghai market is so big. Like you can get like $8 more for silver in China, in Shanghai. And why is that? Well, because the contracts in China are actually based on real physical metal, and it reflects the real price. It's real price discovery. What it's led to is a shortage, a deficit in the last 5 years, because when you keep the price of anything down artificially, you create shortages because producers stop producing because it becomes uneconomic to do it, and that's what's happening in silver.
People are buying silver because it's a way of protecting their assets against the unknown. If you've got silver coins, the more we have restrictions, the more people will find alternative ways of trading. So getting your silver coins while you still can get them is one of the factors going on. We've also had the fact that there's a bit of a supply shortage of silver. I mean, it's been since 2021, we've been in supply deficit, and that looks like it's going to continue for the foreseeable future.
Silver's global pricing is starting to fracture, revealing real physical stress. Premiums between Western paper markets and Asian physical markets have widened, with Shanghai pricing several dollars higher than COMEX and LBMA, signaling tighter supply where delivery actually matters. Innecco and Clive Thompson point out that Chinese contracts are backed by physical metal, making them a more valid form of price discovery. Years of artificially suppressed prices discouraged production, pushing the silver market into a persistent supply deficit that has existed since 2021. As restrictions grow and confidence in paper claims fades, investors increasingly view physical silver as a form of protection rather than speculation. That shift is reinforcing shortages, especially in coins and small bars, and keeping premiums elevated across physical markets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There's talk as well of how the premium between the price on COMEX and LBMA and the Shanghai market is so big. Like you can get like $8 more for silver in China, in Shanghai. And why is that? Well, because the contracts in China are actually based on real physical metal, and it reflects the real price. It's real price discovery. And I'm afraid what that's doing, well, not really afraid, because I think it's about time that the COMEX and LBMA went the way of the dodo bird, right? What that's doing is encouraging people to take delivery, buy on COMEX, LBMA, and ship the silver and get a profit in China. And that's going to continue unless, of course, and the arbitrage, it's called an arbitrage, that will end once the price, the Western price catches up. But by then, we could be a lot higher. But as I said, I'm not surprised that after the break of that teacup, the top of the teacup, it's been explosive, because there's so much pressure, so much manipulation for so many decades, some would argue for over a century, of silver, that what it's led to is a shortage, a deficit in the last 5 years. Because when you keep the price of anything down artificially, you create shortages because producers stop producing because it becomes uneconomic to do it, and that's what's happening in silver. But what I really want to cover today actually is a couple of things. The most important one is the Dow-Gold ratio, and yes, it's also got to do with silver because we can extrapolate from that. But I think we could be in for a very turbulent and chaotic next 2 years, not just in precious metals, but in the financial markets, in the stock market, in the bond market. And why do I say that? Back to the Dow-Gold ratio chart. It goes back to like the 1890s, but I've got it from like early 1920s. And you can see that we have reset number one. And what was that? Well, that was after the crash of 1929, we had a bear market for like 4 years, or the market dropped. That crash was the initial move down, and then for 4 years the market kept going down. And by March 1933, the Dow-Gold ratio had dropped to basically 2 to 1. The chart says that it was 1.9 to 1, but let's round it up to 2 to 1. And why is that a reset? Well, because it flushed out paper assets, the stock market, and it shifted the balance from financial assets to money, i.e. gold. And from then on, things started going, let's say the credit cycle started once again, started moving higher. And then and the Dow outperformed, of course, gold. But by the 1960s, I think it was 66, that Dow-Gold ratio topped again. And then it started down. It was over a period of, how long was it? About 14 years, because it took that ratio up until 1980 to come down, right? It wasn't as severe and as short as the first reset. It was more spread out, right? And by 1980, and this was January 1980, from the chart as well, that ratio got down to 1 to 1. It says 0.99, but let's round it up again, 1 to 1. And then we've had actually a boom in financial assets ever since 1980, especially 1981, when bond yields topped around 15%, the 10-year. And we've had probably the biggest creation of money and credit and debt in the history, modern history, or recorded history of mankind. We've had many crises, many bubbles, and you notice that that ratio topped actually in late 1999, early 2000, around 45. And you could argue that we've been basically in a bear market in terms of gold for the stock market. Yes, since 2011, the stock market has rebounded. That's because the central banks learned a lesson, not a great lesson. They learned that if they wanted to stop what happened in 1929 to 33, they had to print and borrow and throw everything at it. But that's not natural, right? And now I think despite how long it took, you can't kick the can down the road forever. And I think, as you can see, this ratio is breaking through key support. We're around 1081 right now. The other thing that you can see from this is the time that it took, let's say, for this to happen. So we can extrapolate from 1933 to 1980, March 1933 to January 1980. Let's say that's 47 years. And I'm not saying this is going to happen for sure, but there's a high probability. There's a cycle here, a 47-year cycle. And I've spoken to you about this. So it's really simple. You add 1980, you add 47, to 1980, you get 2027. And that's why I said in the beginning here that we could be in for some turbulent, chaotic times in the markets, in the economy, geopolitically. But one thing I'm fairly convinced of, and of course, nothing is certain in life. One thing that I'm fairly convinced of is that the precious metals, gold and silver, are going to continue to outperform the stock market, the bond market. And we could, by the beginning of 2027, be back to 1 to 1. Or if you take what happened in 33 and 1980, you could extrapolate that we could be at half to 1. And what does that mean? Well, that means that you only need half a troy ounce of gold to buy one Dow Jones Industrial Average. Of course, you're probably asking yourself, what level do you think that's going to be? Well, it's hard to say. I have a feeling it's going to be very high for both. And why do I say that? Well, because I think we're going to see a currency event, and the dollar is going to drop massively, not just versus gold, but somewhat versus the other fiat currencies. And I'm not saying the other fiat currencies is the place to be. It's not. Gold and silver are, and hard assets in general, productive assets as well.
Silver is increasingly trading as two separate markets. In Asia, where contracts are backed by physical metal, prices are several dollars higher than on Western paper exchanges. That gap reflects real supply stress and encourages arbitrage, with metal flowing out of COMEX and LBMA inventories toward Shanghai until prices converge. Years of suppressed pricing discouraged production, leaving the market in a structural deficit that has persisted since 2021. As delivery becomes more important than paper settlement, price discovery naturally shifts toward physical venues. At the same time, broader financial cycles are turning. Long-term ratios between financial assets and hard money are breaking down, signaling a transfer of value away from stocks and bonds toward gold and silver. In periods of currency instability and rising debt, hard assets historically outperform as capital seeks durability rather than leverage. Let's get back to the interview.
Why is silver going up? Well, it's gone up this year because of a huge surge in demand for solar panels. Electric vehicles are using more and more silver because there are more of them. The AI infrastructure.
Why do solar panels need silver?
Well, if you want a solar panel to work, one of the main ingredients is silver. I can't tell you about the scientific way of it works, but solar panels use silver. So the more solar panels there are, the more silver they need. So silver has been in a deficit for several years. And of course, with these, the extra demand for solar panels, the silver supplies which are available for using by the solar panel manufacturers is getting less and less. And they're competing with the auto industry for the electric vehicles. Other things which are going on are the same kind of factors which are causing people to want to buy gold, such as safe haven investors.
What's safe haven?
People buy silver. So what's safe haven, you asked? People are buying silver because it's a way of protecting their assets against the unknown. So if you own a bag of silver coins and suddenly you find your bank account frozen, or you have to get your hands on some money very quickly and your bank's not going to let you have it, perhaps because some rule or something like that, or because we're into CBDC and they've decided that you're not the sort of person who should be allowed to spend money. Well, if you've got silver coins, the more we have restrictions, the more people will find alternative ways of trading. So getting your silver coins while you still can get them is one of the factors going on. We've also had the fact that there's a bit of a supply shortage of silver. I mean, it's been since 2021, we've been in supply deficit, and that looks like it's going to continue for the foreseeable future. Jerome Powell's term ends in May 2026, and Trump will find a replacement for him, and that will be somebody who's very much in favour of cutting interest rates. So I think we will probably get, ultimately, the 1% interest rates that President Trump wants. What else will be going on in 2026? Well, QT has ended, quantitative tightening. We've gone into quantitative easing, sort of, but I think that's coming with a vengeance later in the year. I think as we go into the second half of the year, the Federal Reserve will be buying not just T-bills, they'll be buying T-notes and T-bonds. T-bills are the US paper, the money that government's borrowed up to 2 years. T-notes are 2 years to 10 years, and T-bonds are the bonds with more than 10-year maturity. So I think the Federal Reserve will be buying all of those, and it will be printing the money with which to buy them. Mid-year, we should have the BRICS summit. This will be the third BRICS summit at which the possibility of having an independent international currency for international trade will be discussed. At the moment, the dollar is undisputably the winner, the leading currency, and it's still going to stay that way. But of course, the aim of the BRICS countries is to have an alternative, a plan B, if, for example, they can't use the SWIFT system with dollars. and we go back to the weaponization of the dollar. So it could be there's further discussions about the introduction of some sort of BRICS currency. That's Brazil, Russia, India, China, and South Africa, and all the other countries which will join into the BRICS arrangement. I think there's quite a few now. We can expect more Federal Reserve easing on interest rates. I've mentioned that already. Government debt will keep climbing. We are kind of in the USA and several other countries, we're already in crisis mode. Lots of European countries too. It's unsustainable. Will there be a crisis related to debt? Could happen.
The other chart I want to show you is the dollar index, because we've been for the last few months, well, quite a few months here, because this is a monthly chart. For the last 6 or 7 months, dollar index has been holding on for dear life above this trend line, or right under it, or right on it. And I just noticed that it's created a bear flag, which is very bearish. And 3 times out of 4, bear flags come to fruition. One time out of 4, the market just rebounds. But I think this is pointing to more trouble for the dollar. What this is telling me here, and the target here for this move, this bear flag, would be around 87 by the beginning of April 2026. I don't think it would be the end of the bear market for the dollar versus other fiat currencies. But as you can see as well, in the long term, it doesn't seem to matter, because the dollar bottomed just above 70 in 2008, and gold was just above 1,000 at the time. And here we are now at 98 almost, and gold's at 4,500. So what I'm trying to tell you, expect gold to outperform all currencies out there, and that's why trying to hedge dollar weakness with other fiat currencies is a losing proposition. The only reason I'm showing you this is that in the short term here, in the next few months, this could help gold and silver even more.
Silver's strength this year is being driven by real-world demand colliding with structural supply limits. Solar energy continues to absorb large volumes of silver, as the metal remains a critical input that cannot be easily substituted. Electric vehicles, charging infrastructure, and AI-related data centers are adding further pressure at a time when the silver market has already been running a supply deficit since 2021. That industrial demand is now intersecting with rising investment interest as people seek tangible protection against financial uncertainty and the growing restrictions in the banking system. Physical silver offers portability and optionality when access to traditional money is limited. On the macro side, easier monetary policy, expanding government debt, and renewed liquidity injections are reinforcing the case for hard assets. A weakening dollar environment only accelerates this process, allowing silver and gold to outperform currencies rather than chase them. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.